Here's something most high earners don't realize. If you make between $150,000 and $500,000 per year, there's a good chance you're overpaying taxes significantly. Not necessarily because you did something wrong, but because most of the time you're too focused on filing taxes and not planning for them. I'm a financial planner, and one of the most valuable things we do for our clients is coordinate tax strategy with their CPA so they stop leaving money on the table. And today I'm walking through 5 tax strategies that high-income W-2 professionals should at least be evaluating. The first strategy is the Mega Backdoor Roth. If you're a high earner, the IRS usually blocks you from contributing to a Roth IRA. And I'll get to that point in a couple of minutes. But many professionals completely miss one of the most powerful loopholes available inside of their 401k. It's called the Mega Backdoor Roth. Most people think the 401k limit is $24,500 if you're under 50. But the total limit, including employer contributions, is really $72,000 if you're under 50 or $82,000 if you're 50 and older. If your plan allows after-tax contributions and Roth conversions, you may be able to move tens of thousands of dollars each year into Roth accounts. That means tax-free growth for decades. For a 40-year-old investing an extra $40,000 annually, that could create over $2 million in tax-free retirement assets. Your first step in implementing this tactic is ask your HR rep if your plan allows after-tax contributions and in-plan Roth conversions. Strategy number 2, donor-advised funds. If you donate regularly to your church, your university, or nonprofits, you may be missing a major tax opportunity called a donor-advised fund. You see, we're often the first in our families to reach these income levels. We're also more likely to give back to our communities, our churches, our HBCUs, scholarship funds, and social justice organizations. But nobody taught us to give strategically for tax purposes. We just give from the heart, which is beautiful, but you can give from the heart and be tax smart. That extra money you save in taxes, that can go to your kid's 529 plan. That can go to building your own wealth. That can go to giving even more next year. Here's the thing, because after the tax law changes a few years ago, most people no longer itemize deductions, which means many people get no tax benefit from charitable giving. A strategy called donation bunching fixes that problem. Instead of giving $10,000 every year, you might give $50,000 one year into a donor-advised fund. When you do that, you get the entire deduction immediately. Then you can distribute the donations to charities over time. Even better, if you donate appreciated stock instead of cash, you can avoid capital gains taxes entirely. That's double tax benefit. Strategy number 3, the HSA wealth strategy. Most people treat their health savings account like a checking account for medical bills. High earners treat it like a stealth retirement account. Why? Because HSAs have something no other account has. The first is tax deduction going in, the second is tax-free growth, and the third is tax-free withdrawals for medical expenses. That's a triple tax advantage. Sophisticated planners often recommend paying current medical expenses out of pocket and letting the HSA stay invested for decades. So during your next open enrollment, if your employer offers a high deductible health plan option, run the numbers. Often the premium savings plus the HSA contribution make it the better financial choice, especially for high earners who can afford to cover the deductible if needed. Strategy number 4, Backdoor Roth IRA. If your income is too high to contribute directly to a Roth IRA, there's another workaround called the Backdoor Roth. For this strategy, Congress left a loophole in the tax law, probably intentionally. And you know what? We're going to use it. It's surprisingly simple. You contribute to a traditional IRA with after-tax dollars, then convert that contribution to a Roth IRA. Done correctly, this allows high earners to still build tax-free retirement accounts every year. But there's one big catch called the pro rata rule, which is why this strategy should usually be coordinated with a planner or CPA. Strategy 5, strategic Roth conversions. The final strategy is Roth conversion planning. Many high earners build large balances in traditional retirement accounts. The problem comes later. Required minimum distributions can push retirees into a very high tax bracket. Strategic Roth conversions during lower income years can reduce that problem dramatically. For some clients, careful conversions can save tens of thousands of dollars in lifetime taxes. Listen, we're building generational wealth over here, and often for the first time in our families. When you pass away, your kids inherit your Roth IRA tax-free, and they have to withdraw it within 10 years under new rules, but they pay zero taxes on those withdrawals. Your traditional IRA, they're paying full income tax every dollar they inherit. If you're intentional about building legacy wealth, Roth conversions are essential. So how do you prioritize these? If you're making between $150,000 and $500,000 per year in W-2 income, here's how you should prioritize these strategies. First, max your employer retirement match. Second, evaluate the Backdoor Roth IRA. And third, optimize your HSA if you have access to one. Fourth, investigate Mega Backdoor Roth opportunities. And fifth, build a long-term Roth conversion plan. The key is coordination. None of these strategies exist in isolation. Tax planning doesn't happen automatically. Your CPA files taxes, your financial planner helps design the strategy. When those two professionals actually work together, that's when the real tax optimization happens. Look, the tax code is complex by design. It benefits people who understand it and penalizes people who don't. For too long, these strategies have been concentrated in country clubs and wealth management firms, but not anymore. You don't have to do everything at once, but you do have to start. Drop a comment telling me which strategy you're implementing first. Subscribe and share this with someone in your circle making six figures who needs to hear this. The wealth gap is real, y'all, but I got you. We're closing it, one strategic tax move at a time. See you later.